What if America had triggered its own downfall without even realizing it? While China and Russia turn their backs on the dollar, the foundations of U.S. economic power are starting to crack. What you're about to discover could completely change how you see global trade and your own future. In this video, you'll uncover how China and Russia are quietly reshaping the global economic order, walking away from the U.S. dollar. Behind Washington's trade wars lies a systemic weakness that threatens not only Wall Street, but the entire American economy, from local small businesses to giants like Apple. You'll see how global supply chains are being redrawn, how U.S. exports are collapsing, and why, if this trend continues, the dollar's dominance may be in serious danger. Buckle up, the global reset is already underway. China and Russia have just slammed the door on the U.S. dollar, not in some theoretical future, but right now. Commodities like oil, rare minerals, and semiconductors are now being traded in rubles and yuan. As Washington urges Beijing to further open its markets, American exporters are being bled dry. Small businesses are shutting down one after another, and Asian central banks are quietly sitting on a $2.5 trillion ticking bomb in dollar reserves, ready to detonate. Trump insists that tariffs are a strategic tool, but what if they're actually a loaded weapon pointed at his own economy? Stay tuned, because the consequences are already rippling through Wall Street, and your job could be next. How can a country demand entry into someone else's house while locking its own doors from the inside? That's the paradox at the heart of Trump's latest trade negotiations. Washington is pressuring China to open its market to U.S. companies while upholding a 145% tariff wall that suffocates Chinese imports. And this isn't theory, it's measurable reality. As of May 2025, U.S. importers have to price a $10 product at $18 just to break even. According to analyst Scott Bessent, this is all meant to secure a great deal for the U.S. Yet as Washington demands more and more concessions, it offers less and less in return. Still, the numbers speak for themselves. American exports to China exceed hundreds of billions of dollars and support over 500,000 U.S. jobs. But the shift is already happening. And here's where it gets even stranger. If the U.S. truly believes that access to Chinese consumers is essential, why is it making its own products more expensive, less competitive, and harder to sell abroad? This contradiction doesn't just weaken America's bargaining power, it places U.S. businesses on the defensive before talks even begin. At the ports of Los Angeles and Long Beach, container volumes arriving from Asia have dropped nearly 40% year over year. But that drop hasn't affected China in the same way. It simply redirected its exports. According to April 2025 trade data, while Chinese exports to the U.S. have fallen by 20%, total Chinese exports have actually risen by 8.1% in value. Beijing has shifted its shipments to Southeast Asia and Europe, where import volumes have grown by double digits. And this rerouting isn't random. It's the result of supply chain restructuring that began in 2023. The U.S. hoped tariffs would freeze Chinese factories, but China recalibrated. It swapped one major trading partner for 10 new ones. So the real question is, have these tariffs truly pressured Beijing, or are they merely redirecting global trade to more welcoming markets? If China can so quickly redesign its trade routes, what does that say about the true nature of economic dependence? Who really relies on whom? Beijing hasn't issued dramatic press releases or sweeping bans. It simply imposed a 125% tariff on American goods, then quietly walked away. And the outcome is obvious. U.S. exports to China have collapsed. American brands like Apple, McDonald's, and Starbucks are losing ground in cities they once dominated. S&P data shows that U.S. companies generated over $1.2 trillion in revenue from China last year, 4 times the size of the U.S. trade trade deficit. But the shift is already happening. Today, local Chinese chains like Le Kink Coffee are competing with Starbucks, while Huawei is regaining market share from the iPhone. If this trend continues, U.S. brands won't just lose profits, they'll lose influence. This is the core issue. Can American exporters survive a market freeze, or is Beijing quietly closing the window on their future?
This is where everything starts to turn. The White House interprets the collapse in maritime shipments as a strategic win, a form of supply strangulation meant to force China's hand. But what if it's not a lever of control at all? What if it's actually proof of self-inflicted damage? In May 2025, Scott Bessent met with Chinese officials in Switzerland. Trump called the meeting very productive, but no statement followed, no agreement, no framework. Meanwhile, small U.S. businesses are sounding the alarm. From Massachusetts to Kentucky, companies are being hit by canceled contracts, shipping delays, and skyrocketing costs. Take WS Game, for example. It lost $16 million in retail orders, with $500,000 worth of products stranded in China. If this is what Washington considers a strategy, then it's blind to the smoke coming from its own engine. When your supply chain grinds to a halt and your exporters are crumbling, maybe it's not your rival blinking, it's you. This spring, in a joint declaration, Russia and China formalized what the markets had already sensed. Their bilateral trade is now almost entirely settled in yuan and rubles. This includes not only oil, gas, and minerals, but also high-value industrial goods. Their stated goal? To build a durable system that can withstand outside pressure, a clear reference to Western sanctions and dependence on the dollar. And the numbers back it up. In April 2025, over 50% of China's total trade was conducted outside of the US dollar. According to SWIFT data, the yuan share of international transactions rose from 2% in 2021 to over 4.3% in Q1 of 2025. But the real shift isn't just in payment systems, it's in trust. A dollar only holds value as long as people choose to use it. Today, Beijing and Moscow are actively constructing trade networks that operate independently of it. So the only real question left is, who's next to join them? Because a financial time bomb may already be ticking beneath the dollar, and the detonator sits on a massive stockpile of $2.5 trillion. According to economist Stephen Jen, exporters in China, Taiwan, Vietnam, and Malaysia have built up these reserves since 2020. Now, that stockpile is becoming unstable. After trade talks between Washington and Taipei, the Taiwanese dollar jumped 8% in just 48 hours, its sharpest movement since 2007. That surge triggered a domino effect across Asian currencies. In 2025, the ICE dollar index fell by 9%, and according to Stephen Jen, the markets now expect a massive but uneven sell-off. In simple terms, multiple countries may dump their dollar holdings simultaneously, each trying to avoid being the last stuck with a depreciating asset. This isn't just a speculative move, it's a structural signal. The Federal Reserve is expected to cut rates by 75 basis points this year, and dollar-based assets are already overpriced. Faced with this backdrop, Asian central banks are left with one urgent decision: sell quietly now or risk being crushed in the chaos. And their answer may reshape America's entire global financial role, because the fallout has only just begun. In Massachusetts, Dus Gamiko saw $500,000 worth of inventory stuck in Chinese ports, then lost $16 million in retail contracts in a single quarter. In Oklahoma, 4K9, a company that imports dog seat covers, was crushed by tariffs that wiped out its ability to meet surging demand. In Michigan, Lisa McDonald's tea shop, which relies on premium Chinese leaves, says it's only weeks away from being forced to raise prices beyond customer tolerance. 3 different industries, one shared message: no help is coming. These aren't Fortune 500 giants. They're local American brands, agile and resilient, but now outmatched by a trade policy that doesn't even seem to notice they exist. Trump's tariff strategy hits small businesses the hardest. Unlike multinational corporations that can pivot supply chains, these local players can't reinvent decades-old sourcing methods overnight. And while Scott Bessent continues to claim that the U.S. remains the world's top investment destination, small businesses are drowning long before any of that capital reaches them.
So what happens when the very economy Washington says it's protecting can't survive the cost of that protection? Even if a deal is reached, the tariffs won't vanish. According to U.S. trade officials and direct statements by Bent at the Milken Institute, Trump plans to implement a permanent baseline tariff of 10% on all imports, even from America's allies. This isn't just about punishing rivals. It injects structural costs into every layer of the U.S. supply chain. According to the Kiel Institute, this policy could slash U.S. exports by 17%, forcing domestic producers to either absorb the extra cost or lose market share. Meanwhile, China and its trading partners expect only a 5% dip in their own exports, which they can easily offset with lower production costs and leaner operating margins. In short, the country pushing hardest to reshape global trade is also the one making its own products the least competitive. And now that tariffs are baked into everything from components to consumer goods, the very industries that were supposed to be protected are being pushed out of global competition. But what if none of this is even about economics anymore? What if the true goal is to project strength, no matter the cost? If China walks away, Wall Street may follow, and the dollar could be dragged down with it. Because if Chinese consumers stop buying American goods, the impact will be swift and brutal. In 2024 alone, the U.S. exported over $140 billion in goods and $46 billion in services to China. These flows support nearly 900,000 direct American jobs. California alone exports $15 billion per year. Texas tops $21 billion. But the real threat isn't just to exports, it's to the entire financial ecosystem. According to S&P Global, American companies derive about 7% of their annual revenue from the Chinese market. If that disappears, so do forecasts, dividends, and investor confidence. And when Wall Street bleeds, the dollar limps. Global demand for U.S. equities and treasury bonds relies on 2 pillars: growth and perceived stability. Remove Chinese consumers from that equation, and it's not just financial reports that take a hit, it's the entire structure of U.S. assets. Investors don't wait. They flee at the first sign of contagion. So here's the real question. Can the United States maintain a dominant dollar while pushing away its largest trading partner? This is no longer just a tariff war. It's a systematic dismantling of the post-1990s global trade consensus. And the data shows the tipping point has already passed. China has redirected its exports, decoupled its monetary flows, and tripled settlements in yuan. Russia has completely cut the dollar out. Asian exporters are preparing for a collective exit. And while Washington insists its markets remain open, its tariff policy says the opposite. Small businesses are collapsing. Wall Street is exposed. And the dollar is trembling under the weight of policies designed to look strong, but that may be strategically fragile. So ask yourself this final question. If the dollar no longer anchors global trade, can the United States still claim to be the center of gravity in global power? And what happens to every business, every loan, every investment tied to a currency the world may soon decide is no longer unquestionable? Thank you for watching all the way to the end, and for your attention. If you found this video insightful, don't forget to subscribe and turn on the notifications so you never miss another deep dive like this one. We'll be back soon with more content that cuts through the noise and reveals what's really going on behind the headlines. See you next time.